Hello traders, and welcome to another Wednesday's educational session here at ROI Forecast. In today's educational session we will talk about what really defines a great trader, right? We will go through why the win ratio is mainly relevant, if the risk to reward ratio is small. We will go through what is a realistic win ratio in trading, right? Which will never be 80% in the long run. Understanding the importance of the risk to reward ratio and the relationship to the trader's P&L, and why short-term trading and looking for quick take profit will result in long-term losses, right? And the need to be able to define the next major move in the market, right? So just to give you a small example with a table before we see a visual representation on the charts, okay? You can see that with the risk to reward ratio starting from 1 to 1, for example, the win rate which is required to break even, which means to not lose money, is 50%. It means if we are trading with 1 to 1, it means we need to win more than 50% of our trades if we are going to make any profit of this market, right? And as you can see, the higher the risk to reward ratio, the lower the break-even point becomes in terms of the percentage of the win trade ratio we need to have. And this is very important because in trading the realistic win rate ratio is between 50 to 65-ish% over the course of the long run. We are talking about not 1 month, we are talking about yearly and multiple years right now. So it's a long-term number, okay? So nobody hits 70, 80, 90% win rate in this market, okay? We'll go through that as well. So as you can see, the numbers do not lie. At the end of the day, 1 plus 1 equals 2, right? So we need to see the numbers. So if we are trading with bad risk to reward ratio, it means that we are taking bad value. So I just make an example in real life, so kind of so you can understand what we're trying to say. So imagine someone buying 1 kilo of oranges for $1.50 per kilo, and another person buying the same oranges for $5 per kilo, right? So who managed to get the better value in this case, right? Number 1 or number 2? I think it's very clear who got the better value, and we have to relate this to our trading, okay? So our long-term expected positive value will not be positive if we trade 1 to 1 and lower, right? Because of the ratio, okay? There is no trader that wins 100% or even 80% unless you are watching a fake forex trader's content. This is another story. The overall win ratio, okay, overall, okay, this is an average figure, fluctuates between 50 to 65% towards the better traders in this industry over the long run. Yes, we are talking about years. So we're not talking about 1 month or 2 months or 3 months, we're talking about years. Now, we still need to have high quality trading ideas and setups, okay? Otherwise, higher risk to reward ratio is still going to fail if you don't know what you are doing. So, before we continue, we will go through the charts for visual representation. I'm just going to give an example here on the charts so you guys can understand the differences and what we are trying to say in practical examples. So let's say we have an example of 2 traders at the same market, Euro Yen. This is trader number 1 and this is trader number 2. So trader number 1 has decided that this is a pullback right here. So he's looking to buy the market at this pullback right here, okay? And it's targeting these higher prices right here, 162,500 area. He has entered in the pullback, and his stop loss, as you can see, it's above the previous low. The reason is obviously he really understands the market, so he knows that if the price comes down here, it means it's not a bullish market and the price can break lower. Now, why he put the target right here and the risk to reward ratio is 1 to 7? It's very simple. He knows if this is a bullish market and this was the pullback, when we are measuring the Fibonacci retracement on the inverse, in this case, we have a target area of 162,787 to 164,242, and this trader has decided even to play it safe, and the target was a little bit below the 1.236 Fibonacci inverse retracement of this move. Okay, so this was a 1 to 7 risk to reward, and here we have trader number 2, who doesn't really understand the market, who knows a couple of basic things, but he doesn't understand the bigger picture, right? So what he's doing, he has bought the same market, let's say at the same price, for example. He has put a stop loss below this low right here, which is wrong in this case, because if this market is really a trending market to the upside, you don't want the stop loss to be below this low, because it's going to lose you more money if it was wrong. And anyway, the market shouldn't go below this area right here if this market was really bullish. Okay, number 2, he put his target area at 160,200, obviously because he doesn't know, or he doesn't understand the market, so he's not comfortable or confident to have a bigger target, right? So he has a risk to reward ratio of 1.46. Now, if I put them both right this together, okay, if we put them here for comparisons, okay, next to each other, I can let's say assure you guys that this trader right here on the left side against this trader right here, in the long run, okay, this guy is gonna have much better results than this guy, whereas this guy has a much higher risk of even losing money in the long run. So because obviously it doesn't take into consideration what is happening in the market, he doesn't really have good knowledge, great knowledge of the market, where this guy, it's a very knowledgeable guy. He knows about the market dynamic, what to expect and why. He's very prepared before he decides to trade. And also this type of trades will not be as frequent as this one, which is what we are explaining, the difference between a high quality trader and a low quality trader. Okay, at the end of the day, that's why in life in general you have high quality products and you have lower quality products. This what defines also the difference in this industry in trading. I hope it makes sense. Okay, so this was just a practical example for you guys to understand the two differences. So now, if we take example with numbers, right, between trader A and B. So we have taken two examples here. Trader A with a 1-to-1 risk to reward ratio and trader B with a 1-to-4 risk to reward ratio in this example. So it's an average, right? And we took two examples. One of them with 6 wins and 4 losses between a set of 10 trades, right? And example number 2 between 4 won trades and 6 losing trades. So let's evaluate both. So trader A in this set of trades, when he won 6 trades and he lost 4, we have just put for the example a $1,000 risk, okay, per each trade. So, and also with a 1-to-1 risk to reward, with 6 trades, he has won $6,000 and he has lost $4,000 with 4 losing trades. At the end of the day, he managed to make a $2,000 profit in this example, which is a 60% win ratio in this example. Now, and trader B with the same risk, okay, just the higher risk to reward setups. With the same number of trades, he has managed to make 10 times more, and he made $20,000 profit, but just by understanding how to trade high risk to reward ratio trade setups, right? And then in example number 2, we had a period that obviously the market was more challenging, which will happen many times within the year. And right here, trader number A lost 1 4 trades and lost 6. It can also get worse depending on the case. Okay, this is just an example. So we can see how trader A has lost $2,000 in this case by winning 4,000 and losing 6,000 on the losing trades with a 1-to-1 risk to reward, whereas trader B with a 40% win ratio, he has won 16,000 and lost 6. So at the end of the day, he made $10,000, whereas trader A lost $2,000. So I hope it makes sense, guys, and why this is important. I mean, the numbers, they don't lie, as you can see. 1 plus 1 equals 2, so we cannot show something that is not valid if we have the numerical data, of course, right? So let's go now to some psychology and how we need to be thinking. So what is wrong with the majority of traders? They are impatient. They cannot wait to take good setups or bigger targets, right? Because they don't understand how the market works. We have already spoke about the key factors such as cycles, dynamic sequence, and defining the market rotation period. If you don't know what is the market rotation period, you can learn if you join our service at ROI Forecast with the link in the description. Then the other mistake is that they get out of the trade when in profit quickly. And when in loss, there is no stop loss in many cases, or they allow for bigger losses, right? That's the biggest mistake traders make. And we need to understand the need of patience, clear mind, good quality analysis, and being objective and never biased in the market, because we really need to see the market to what it is and not try to force our opinion in the market. Otherwise, we are going to have very bad consequences, okay? And we need to follow the market footprints. Now, I will now speak about why, again, only a higher risk to reward or better risk to reward ratio alone is not enough to become a great trader, okay? Because obviously, if you don't know what you are doing and your analysis or ideas suck, this is not going to change anything at the end of the day. So the need of market knowledge, changing dynamic and cycles, use of multiple factors to determine the market path and sequence. Many of these factors I have listed here, such as timing, seasonality, correlations, not what majority know, okay? We're not talking about the basic stuff you can find everywhere online like this. Relationship between certain instruments and markets. Order flow analysis, okay, and market rotation periods, market behavior, and also the need of a good entry system where we define our entries, stop losses and targets, and the trade management. At the end of the day, we are looking for a 90% ratio of analysis, and only 10% of the time we are executing trades and managing trades. That's how it really works. And as conclusions, we can put that the risk to reward ratio is of high importance when trading, of course. But again, we need to define the high quality setups and avoid certain periods in the market. Quality over quantity will make the difference in the long run, of course. And the need to really learn how the financial markets work and understand the things that we already explained, okay? And of course, it's not easy for most people, and that's why one of our missions and why we started ROI Forecast is we have a professional service. You can join us. We conduct also the live sessions with a premium plan. Feel free to check it out with the link in the description. We also have listed our recently opened Trustpilot page where our real members they have shared their feedback. Okay, so you can understand where we're coming from, and if you have any questions, feel free to get in touch with us at support@roiforecast.com. All the links you need are listed in the description of this video and all the videos we publish on the channel. So do not hesitate to get in touch with us if you have any questions, and we would appreciate if you leave us a like, subscribe, and turn on your notifications so you are always posted when we have new content on the channel. And with that note, guys, I would like to thank you for watching the video. Enjoy the rest of your days and the rest of your week, and we'll see you in the next video on Sunday with the weekly forex market forecast.